Welcome back to the deep dive. So, our mission today is to take a look at this stack of really dense source material we've got.
Yeah, there's a lot here. We've got articles, market reports, a bunch of internal notes.
And we're going to give you the shortcut to understanding the recent history and, frankly, the pretty volatile future of financial technology. Fintech.
It's been a wild ride.
Hmm.
The sources we're pulling from, they chart these huge macro shifts, but also, I think, the complete maturation of an industry.
And it all seems to be building towards this massive acceleration from AI.
Exactly. The whole ecosystem has changed, and we want to show you exactly how and why.
Okay, so our deep dive for you today is focused on three main things. First, we're defining what the sources call the seasons of fintech since 2018.
From the big EDM pumping summer to a really brutal winter.
Second, we need to understand this critical pivot from solving what's called the access problem to the much harder excellence problem. And finally, and this one is fascinating, we're going to reveal the single biggest, most surprising use case for AI in finance right now.
And it's probably a lot more chaotic than you think. Let's start by just laying the groundwork with those macro cycles.
Yeah, that seasonal analogy in the sources feels perfect. It describes the cycle of just whiplash-inducing boom and bust. So what did that initial period, that late spring, what did it look like?
Well, if we start around 2018, maybe 2019, the industry was already kind of past its earliest, most experimental phase.
It wasn't a brand new idea anymore.
Right. The sources describe it as seeing a million flowers bloom. I mean, companies basically realized they could take almost any traditional financial service and just deliver it digitally, outside of a physical bank. This was really the moment of scaling.
And this is where you, the consumer, really saw that explosion.
Yeah.
The early trading apps like Robinhood, the huge number of neobanks that started popping up.
Oh, targeting every possible niche market.
Exactly. And of course, the first big wave of consumer crypto apps that made buying and selling really easy, it felt like good, steady, predictable growth.
It was. But then you get to mid-2020 through early 2022, and the season just changes violently.
It's a COVID inversion.
A total economic inversion. You have consumers locked down, but with just unprecedented liquidity, all fueled by these incredibly low interest rates. The sources call this period of, well, utter insanity, the big EDM pumping summer.
And that EDM analogy, it's not just the chaos, is it? It's the nonstop liquidity. The music literally never stopped.
Because the low rates just kept pumping capital into the system. It basically made speculation the national pastime.
The stats are just stunning. During that time, 25% of all venture capital dollars went into fintech.
A quarter of all VC money.
To one single sector. It's unbelievable.
And that capital led to this rapid feature chasing, a feeling that if you weren't growing 300% year over year, you were basically failing.
But that whole environment was completely dependent on one thing.
Low interest rates. They drove massive lending volumes. And when the macro climate shifted, the party just ended. Abruptly.
And there was no fall. It wasn't a gradual cool down.
No, it went immediately into a brutal fintech winter. Second half of 2022 through most of 2023.
So if 25% was the high, what was the low?
The crash was immediate. The sources say that starting in the second half of 2022, basically 0% of venture dollars went into drought.
Zero.
And that rising rate environment, it didn't just stop new investments. It fundamentally changed the business model for everyone.
You couldn't just rely on cheap lending volume anymore.
Not at all. Companies were forced to pivot their entire revenue mix. The focus shifted to deposits, to savings products, to long-term customer value.
But doesn't that raise an interesting question? If you force these neobanks to become full-fledged institutions, aren't you just diluting their original mission?
That's the tension, yeah.
Are they just becoming smaller, leaner versions of the exact banks they wanted to replace?
That is the tension of maturity, for sure. But the companies that survived that winter, they emerged much, much stronger. And it's precisely because they were forced to diversify. They had to go from a single-feature app to a resilient financial institution.
Adding lending, investment services.
Holding deposits. They gained depth, but maybe at the cost of that initial simplicity.
Where are we now, looking ahead?
We're very much back in spring. The sources are optimistic. They're seeing green shoots, even if some snowmelt is still happening.
So the focus has changed.
Completely. It's now all about long-term responsibility, sustainable growth, and critically profitability. The market is finally rewarding substance, not just speculative growth.
So the industry survived. But what does that maturity actually mean for the average business? The sources seem to suggest that fintech isn't really a distinct startup sector anymore.
That's the core takeaway. It's become synonymous with financial services.
That old saying, every company is a fintech company.
Yeah, a theme we've been hearing since 2018. But now it's deepened into a concrete reality, mostly through the expansion of embedded finance.
And we're not just talking about basic payments here.
No, far beyond that. The sources cite these huge industrial names you would never think of as finance firms.
Like Ford or John Deere.
Exactly. Companies like that now have what they call captive financial services embedded within them.
So finance is no longer an app you have to open. It's just a layer that's operating underneath the experience, whether you're buying a car or leasing farm equipment.
And the reverse is also true for the incumbents. The big banks now say, we are the biggest fintech companies.
Because they invest billions in technology.
Right. They get that technology isn't some separate department anymore. It's the foundation of the whole business.
And this isn't just a Western market story, is it? The scale of this is global.
Absolutely. This proliferation is worldwide. The sources point to giants like Nubank in Brazil, which is reportedly a $100 billion company.
Wow.
And Revolut, valued at $75 billion. The sheer size of these global players just proves that fintech has evolved into global financial infrastructure.
So the industry has completed, let's call it V1.
That's a great way to put it. The first phase of fintech was all about solving the access problem.
Okay, define the access problem for us.
It was about making traditional financial products available digitally and making them faster.
So getting a bank account on your phone in 10 minutes.
Right, or making a remittance payment instantly. Or getting, 30 mortgage offers in an hour online.
That felt revolutionary in 2015.
It was. But fundamentally, it just digitized existing and often very flawed analog processes.
Which sets up the new challenge, the excellence problem.
Exactly.
How do you take those services you've digitized and make them fundamentally better, more logical, more consumer-friendly?
Not just faster access to the same old product, but a superior product altogether.
And where are the biggest opportunities for that kind of excellence?
Well, it involves fixing these structural flaws that have plagued finance for decades. Let's take credit scoring.
Okay.
The traditional system, something like FICO, it's deeply backward-looking. It's designed to figure out your risk based on how you handled debt months or even years ago.
Right. So if you lost your job last year and you struggled, but today you've got a new, much higher paying job, your expenses are low.
Your credit score won't reflect that new reality quickly at all.
It's slow. It punishes people who actually improve their financial standing.
Precisely. It doesn't quickly show what matters most to a lender today, which is your free cash flow. The sources highlight some new products like Plaid's Lens Score, for example. It bases creditworthiness on immediate income and expenses.
Using real-time data.
To create a modern, logical credit score that you, the consumer, can actually understand and influence. That's excellence.
And beyond credit scoring, where else do you see this push for excellence?
It's in making financial services truly embedded. The idea of buy now, pay later, or card issuing, or digital wallets. It all needs to be built into everything.
Seamlessly integrated.
So it's no longer about opening the app. The financial service just needs to be there when you need it.
Which, of course, leads us directly to the game changer, AI. And while a lot of this is still hype, the sources point to a future where AI applications handle these incredibly complex multi-step processes.
Like managing an entire mortgage application.
Through a fully automated AI, because it's just the most efficient way to do it.
What's really interesting, though, is that the immediate investment focus for AI isn't really consumer-facing yet.
Where is it then?
It's focused on solving these expensive manual workflow problems that are hidden deep inside the largest financial institutions, the FIs.
You mentioned the Federation in the sources. That sounds like a spy agency. What does it actually refer to?
The Federation is basically the middle and back office of a huge bank. All the non-customer facing stuff.
So risk management, compliance, legal review.
Vendor onboarding, treasury management, all of it. These massive institutions like Goldman Sachs often rely on highly educated, expensive people using Excel spreadsheets to manually process these complex deals.
So AI is coming in to automate that high-cost, high-complexity work. What are some specific use cases that are driving efficiency right now?
A great one is loan servicing and collections.
Okay.
You can deploy AI voice agents that speak 50 languages compliantly, that are, quote, infinitely patient, and that deliver better results while driving down your labor costs.
Another one mentioned was automating a bond ladder for a wealth management client.
Yeah.
Okay, wait. For the listener, what exactly is a bond ladder?
A bond ladder is just a strategy. You structure a portfolio of bonds so they mature at different regular intervals,
So you always have capital coming back to reinvest.
and you're managing interest rate risk. Doing that manually for thousands of wealthy clients is incredibly time-consuming. AI can now automate the whole process.
That makes perfect sense. And the sources say this tech isn't just being adopted, it's causing this massive cultural shift inside the FIs.
Bottoms-up momentum and top-down pressure.
What does that mean?
It's the most important change. I mean, historically, selling new software into a major bank could take years. The sales cycle was brutal.
Right.
Now, that cultural barrier is shrinking because the CEO or a board member can literally plug a prompt into an AI model, see the value immediately, and then demand its implementation.
That intuitive grasp of its power is speeding everything up.
Dramatically.
Wow.
The banks are finally ready to spend on automation.
So this transition from enterprise efficiency, it brings us to the most critical and I think surprising takeaway from all the sources.
It really is. We've been talking about AI as this force for good and for efficiency, but the single biggest, most active use case for AI in financial services right now is the exact opposite.
It's fraudsters committing fraud.
The AI paradox. We're investing billions to automate our defenses.
But the criminals are automating their attacks even faster.
Exactly. And the sheer scope of this is staggering. This isn't some future problem.
It's happening now.
Right now, financial fraud is growing at an insane rate of 18 to 20% a year. The sources explicitly state it's a cat and mouse game, and right now, the mouse is winning.
Wait, hold on. Why is that rate so high? 18 to 20%. Is that just technology scale, or is AI bypassing security layers we thought were safe?
It's both, but it's mainly the scale and the sophistication. See, traditional security looks for technical flaws, like malware or a phishing link. AI supercharges social engineering.
It tricks the human.
It allows criminals to bypass technical security by tricking the user into giving up their funds willingly.
Let's use that deeply unsettling example from the sources. Pig butchering.
It's a horrible term.
Explain what it actually means, because it's a perfect illustration of this AI personalization at work.
So pig butchering is a scam where a fraudster strikes up this long-term personalized conversation with the victim, usually over text or social media. They build deep rapport, emotional trust, sometimes over weeks or months.
And they lure the victim into some kind of fake high-return investment scheme. The term refers to fattening the pig, the victim, with trust before the final butchering, the big financial loss.
And historically, this took human factories in places like Malaysia. You had low-paid workers reading from scripts, sending thousands of customized texts. It was a huge operational overhead.
And now
Now that overhead is all AI. Generative AI handles the conversation, the persistence, the emotional manipulation, the personalization. It does it far better than a human ever could.
it can respond instantly in the victim's language, adopt whatever persona it
I'll
needs.
scale the operation from thousands of victims to millions.
And the defense is so hard because the victim is taking a genuine, authenticated action. They're willingly hitting send on a wire transfer.
Which creates this huge blind spot for security systems that are built to spot technical problems, not genuine human consent. This is accelerating in a way that's really hard to predict.
So if the mouse is winning, what is the cat building? What does defense even look like in this AI on AI battle?
It has to be a fundamental shift away from defending just one institution at a time.
It has to be a network.
The industry is racing to build these sophisticated, network-linked anti-fraud suites, like Plaid's Protect. They're cross-fintech. They're cross-bank. They don't just look at one transaction. They analyze user actions, device data, behavioral patterns across the entire ecosystem to assign a real-time trustworthiness score. It's an existential race.
Okay, so we've covered the macro cycles, the pivot to excellence, and this terrifying AI paradox. It's clear that technology is changing everything. So where does that leave crypto? Is it just a subset of fintech now, or is it something else entirely?
The consensus from the sources is that core human desires, they don't really change over time.
Right.
Consumers still want to speculate. They want to make predictions, spend, save, invest. Crypto mainly just changes the form factor for how they do those things.
So instead of speculating on gold, you speculate on Bitcoin.
Or instead of using a traditional bookie, you use a prediction market like Polymarket to make a bet.
The financial action is the same, just the mechanism is digital and decentralized.
Exactly. And that's why you're seeing this massive convergence between one side of crypto and core financial services. like a
Yeah.
checking account that runs on a regulated stablecoin, like USDC.
And for anyone who doesn't know, USDC is a specific regulated stablecoin that's tied directly to the US dollar.
Correct. And using that kind of tech allows for faster, cheaper 247 transactions. It plugs crypto innovation right into existing consumer needs.
But the real shift, the thing that's making crypto mainstream, it isn't the consumer buying Bitcoin. It's the big institutional adoption.
That is the essential key. The incumbent financial institutions, the biggest banks in the world, they are embracing innovations like stablecoins and, critically, the tokenization of real-world assets.
Turning things like commercial real estate into a programmable digital token.
Exactly. That institutional buy-in is what allows crypto to finally plug into and fundamentally change the broader global financial system.
To ground all these cycles in a real story, let's look at the journey of Plaid. They're a key infrastructure player that really lived through all of these seasons.
Plaid's phase one, say from 2014 to 2019, that was the access problem period. They were just focused on linking bank accounts so you could use Venmo or apply for a loan on Lending Club. They were building the plumbing.
Then came the famous Visa saga in early 2020. They signed the paperwork to sell the company for just over $5 billion, a fixed price.
And critically, the sources note the agreement had a provision saying the deal could not be terminated, not even for a global pandemic.
Which turned into this massive existential drama.
Because the pandemic hits, and the EDM summer begins immediately. Everyone stuck at home shifts their entire financial life online.
And Plaid's business just explodes. It completely rips up all their financial forecasts overnight.
So that fixed-price deal instantly became incredibly expensive for the buyer, for Visa. The company they were acquiring was suddenly worth maybe 2 or 3 times that fixed price just a few months later.
It was a real-time drama of just incredible financial risk and opportunity.
After a year of intense DOJ scrutiny and that massive growth that made the deal pretty much untenable, the companies parted as friends.
But that forced a crucial and probably very difficult refounding moment for Plaid.
They had to scale up from being acquired to running as a massive independent operation, basically overnight.
And they used that subsequent fintech winter to their advantage, right? Instead of panicking, they accelerated their product development.
They gained product velocity. They focused on building out this massive data set for analytics and moving beyond just connecting accounts. That painful crucible period is what allowed them to launch their next-gen products, Protect, that anti-fraud suite, and Lens Score, the modernized credit score.
They went from solving access to solving excellence and security.
Proving that the companies that are forged in that winter really are the strongest.
So here we are, listener, in early to mid-spring. The sources paint this picture of solid products, responsible growth, and a ton of funding bleeding into fintech to use AI. And we are facing these two major accelerating forces that are going to shape the financial world in 2026.
The acceleration of enterprise efficiency through AI and, terrifyingly, the acceleration of organized, personalized fraud.
Those two trends are in direct conflict. Unprecedented trust required for automation on one side.
And unprecedented deceit enabled by automation on the other. It's the central paradox of modern finance.
Which brings us to our final provocative thought for you to consider. The sources all mention the promise of self-driving money, these apps that can autonomously manage your savings and investments.
Right, what we call agentic financial services. AI agents that fully and autonomously manage your wealth without constant human input.
And while a power user might trust that agent, the average consumer is probably going to be asking, where's my money? I don't trust this thing.
A very fair question.
So here's the thought. If AI can convincingly impersonate a friend to steal your money through a sophisticated pig butchering scam, how long will it be until the average consumer trusts an AI to safely and autonomously manage all their money?
The future of finance really depends entirely on solving that paradox of trust. That is a deep dive for another day. Thanks for joining us.